Hi everyone, my name is CA Vijay Kedia. Welcome to my channel. Today we are going to cover basics of equity investing. So this video is for people who have just started their investment journey in the stock markets or equities, or they are planning to start and they don't know where to start, right? Uh, so in today's, first of all, why equities, right? Why do we want to invest in stocks, mutual funds, and so the thing is, in today's world, it's very difficult to create wealth if you're not investing in equities, and in some or the other way, you're already have some investment there. So whether you invest in employee provident funds or NPS or even insurance policies, they ultimately invest some part of their funds in equities to get that growth, right? So if you want to grow your wealth, you'll have to start uh, either directly or indirectly into the stocks, and then over the longer period you will be able to achieve your financial goals. So what I'm going to do is, and I have been already doing that since like almost 17, 18 years. So I'm also going to share my experience in terms of what are the two important things you need to be successful in this journey. And so we'll start with basics and then we'll cover those two important aspects. So with that, let's start. So first of all, when before you start with basics and you start your first investment, you should start that with that mindset that you're investing in a business, right? You're not like doing some lottery where you'll become like rich overnight or things like that, right? So you're buying a part of a business. So enter with that mindset, and then so with that, now what are the basics if you are new to the market? So first of all, what is stock? Stock or a share is a part of a company which company offers it to the public through an initial public offering, which is IPO process. And so that's also called primary market, where company comes to the market that hey, we want to expand, or promoters are offloading some of their stakes, and they're issuing that shares to the public in the primary market through IPO process. So second is like once the shares are there in the market, then there might be other buyers who might be interested in buying those stocks. So the people who are already holding those stocks, they sell it at a particular price, and then somebody is interested in buying at that price. So that transition takes place, right? So in the short term, like how the price is determined, you so if there are more number of buyers who are interested in buying the stock, but there are only few sellers who want to sell, then obviously due to demand and supply equation, the prices will go up, right? But if there is a like a large number of sellers, they want to sell that stock, and there are few buyers, then in that scenario the prices will go down. So that happens in the short term, but in the long term, the prices are determined based on the fundamentals of the company, right? So, what is the earning growth of the company, or what uh, what are the future plans of that company, right? So, the very so basic business fundamental financials, right? That drives the price of the stock in the longer horizon. So, 3, 5, 7, 10 years, right? So, in that kind of time period. So you you also need to understand the very basics financial numbers, right? Okay, what is the revenue, total expenses, how much profit the company is generating, what is the growth of that company year on year. So this is when we you want to invest directly in a stock. And then there are some key ratios, right? So you also need to understand what does that mean, and that will help you to evaluate whether you should enter in that stock or not. So first of all, you need to understand what is earning per share. So whatever is the total earning of that company, like the profit of that company, if you divide by the number of shares which are issued, then you get the earning per share. And then another one is P ratio, and P ratio is a very important criteria to determine whether this particular stock is expensive or cheap. So because the price of a stock is determined as a multiple of the earning per share. So for example, if the current price is 50 for that stock and earning per share is say 5, you divide 50 by 5, you get P ratio of 10, right? So normally in some industry, the ideal P ratio is 20. In some cases, it might be 30. In some cases, it might be lower than 20. So it helps you in the making the peer comparison, that if you are thinking of buying stock in a particular company, then whether it's cheaper or expensive compared to its peers. So P ratio help in that. And then two other important ratios are return on equity and return on capital employed. So whatever profit company is generating, and whatever total equity that company has, so if you divide profit by the capital, you get a return on equity percentage. So, for example, like the company has generated 15 lakh of profit, and then the entire equity capital is 1 crore. So your ROE or the return on equity is 15%. So and normally if it's like more than 15% is considered good ROE. And so yeah, again it depends on industries. And so, and again, return on capital employed is company might also have debt, right? So it might have taken some money from the market on interest, and so you combine the total capital, which is equity, the shareholders money, plus the debt which the company has taken from market. You combine that total capital, and then you divide that by like you divide the profit by that total capital, you get return on capital employed, right? So these are the few things you should try to understand. It will help you to make comparison, and if you're trying to buy a stock from a particular industry, it will help you to come up with a decision whether to buy that stock or buy a peer stock, right? I'm just saying, like, these are the basic things you should know, and just Google these terms, try to understand what does that mean, right? So this is about the so that's the first aspect that you need to consider, what is the basic ratio and the financials. Second, and which is the most important aspect, even important than understanding the financial, which is behavior control, right? And that is and that is totally based on my experience, and we also hear that word, right? The greed and the fear. So, and I read it somewhere that when I was reading a book, Psychology of Money, that wealth creation has less to do with how smart you are, but more to do with how you behave, right? So, if you're able to control your greed and fear, you are definitely going to become a successful investor, right? So first of all, let's talk about greed, right? So when new investors enter into the market, there is an inherent greed, right? They Some people wants to become rich overnight, and so what they do is they start with penny stocks. What are the penny stocks? Which are like a very smaller companies, and sometimes with very doubtful fundamentals, right? Their financials might not be very good, or they might not be doing very good in their business, but still based on some tips that is going to get doubled, tripled, and people invest based on that tips, and sometimes and most of the times actually they lose money. So uh, and then some people straight away enter into intraday trading. Intraday trading is where you buy and sell the stock on the same day. So without taking the delivery, you want to play on that price difference of that stock during the day. So that's also a very kind of risky strategy, not and it's definitely not for newbies. So if you have just started in the market, definitely this is not recommended. And some people even go one step further, and they start trading in like future and options, where you kind of placing a bet on the future price of the stock, right? So it's almost like unless you completely understand the risk involved, and you have spend a good amount of time in this market. So this is like you're taking like a blind betting uh, calls, right? So this starting with like this penny stocks or doing very like intraday trading or future and options in the starting of your investment journey, so that can be very injurious to your wealth, right? So I have seen people who start with this, they lose money, they come out of the stock market, and you hear all kind of stories, right? There's that market is like it's a gamble, and then the people lose money. So we are good buying like say properties and maybe investing in FDs or gold. And so the thing is, if you're into that, if you enter with that mindset, obviously uh, uh, there are high chances that you'll burn your fingers. But if you come with a long-term mindset and having that thinking that you are investing in a business, then you are set for the long-term success. There is no doubt about it, right? So how you can do that, right? So my recommendation is when you're starting in your journey in the stock market or equities, start with mutual funds, right? And then in mutual funds also, like there are various categories. So uh, the first investment which most of the people would recommend is the index fund, right? So what is the index fund? So for example, if you see, you'll have Nifty index or Bombay Stock Exchange, BSE index, and there are other indexes for like smaller companies, mid-sized companies. So for example, Nifty 50 is the index of top 50 Indian companies by market capitalization. So the like the SDFC banks, TCS, Reliance, these are all like blue chips will be part of the Nifty 50. If you go expand it a bit more, say go till Nifty 100, then they are still large caps, but smaller than that Nifty 50. So total 100 stocks, if you buy the top 100 stocks of Nifty, you can buy through Nifty 100, right? So normally you should start your investment journey by investing in index fund. You can buy from any mutual fund house, and maybe you should start with Nifty 50 or Nifty 100 index, right? So if you search that index fund, you'll get multiple mutual funds, and you can probably go with any of them. And these are also called passive funds because the fund manager who is managing that investment, they don't have much say in like which stock to choose and which one to buy, which one to sell. They just mimic the uh, index. So if the index has this 50 stocks, they also need to keep those 50 stocks in same proportion. If the index has 100 stocks, they will keep those 100 stocks in the same proportion. And since they are bigger companies, so the volatility is lesser, right? So because the price, you don't see that upward or downward price movements, like very volatile movements in those stocks, though still on the daily basis you'll see that some movements. But and after that, like after the top 100 stocks, you have from 101 to 250, like in terms of again market capitalization or the size of the company. They are called mid cap index. So top 100 is your large cap, then 100 to 101 to 250 is your mid cap companies, and then which has like moderate kind of risk profile where the risk is also slightly higher because the companies are a bit smaller, like mid-sized companies. And so the daily price movements will be like even up, it will move on the, even on the higher side it will move with higher percentage, and on the lower side also it will move with the big number, right? So you when you're investing in a mid-sized company like that, you can do after say starting your journey through index, and you spend some time and your time horizon is longer, right? So say if you're investing for 3 5 years, it's good that you stay with index fund. But if you are planning to invest for more than 5 years, then you can start mid cap funds, uh, and and then there are like multiple fund houses you can choose from. And then there are small cap index, and nowadays it's becoming very popular. So small cap is like all the companies after that 250 rank, so from 251 to 500 in NSE 500 index, and even below 500 also they are like micro caps. So they're smaller and very small companies. So that companies are like, yeah, the chances of growth is high because they're smaller, but at the same time they are very risky because if and they're very volatile, right? So if the market goes up, you'll see them going up, like with larger percentage, and but when the market is going down, you'll also see your investment values getting decreased in like at a very high rate, right? So thing is, small cap fund is not for everyone, and definitely not for someone who has just started their investment journey. So only if your investment horizon is more than 7 years and you don't want to touch that money during that period, then you can take a small allocation like 10-20% in the small cap fund. And then again, there are multiple fund houses which are offering that. And probably I'll also have a separate video on that what are the funds which I'm holding. But I'm just giving an idea that this is how you should start: index fund, then probably take mid cap funds, and then based on your time in the market and your investment horizon, and then lastly you go for small cap fund. And after that, then you develop some understanding of like how the things work, and you want to take exposure in like individual stocks, then you can basically go for individual stocks. And then there, whatever financials or basic ratios we discuss, you should have a good understanding of that. And then there are other apps also available which will help you to analyze a company, right, from a business perspective, and from a like and financial perspective, right? So my point is, like, if you want to take an exposure into direct stocks, don't go by someone's suggestions, right? So and reason I'll tell you that is that if you have done your analysis, and if you understand the business, you'll have that conviction, right? So for example, I have a very high conviction for, say, uh, electric vehicles, right? Or maybe drones, or some other maybe in technology sector. So and then I select a company in that sector based on their fundamentals and the business growth prospects, right? So I'll have a conviction that yes, I have made a right choice. And even though markets goes down, I'll not sell that stock. Or even if market goes up slightly, I'll not come out of that stock for, say, 10-20% of the gain. Or even if I lose 10-20%, I'll still stay invested. So because if you have bought that stock on somebody else's recommendation, you'll not have that conviction. But if you have done your own research, and you are convinced that the sector or the company is good and it's going to grow in future, it will help you to stay invested during downturns, right? And then over the long term, it can help you to create wealth, right? So that's something is which is very important if you want to invest in the direct stocks. So now the summary is, you should try to understand the basics, financials, ratios, right? And more important than that, you should control your emotions. You should not get too greedy when you're new to the market. And at the same time, you should not be fearful when the market goes down if you have invested with your conviction, right? And so, yeah, and overcoming this behavior, because learning is easier, like learning financials, understanding the issues is easier, but controlling that behavior part is, I would say, it's more difficult. And it comes with time, and I'm still learning that, right? So how to control your behavior, I think that's something which you will build over time when you stay invested. So, and this two things will definitely help you to become a successful investor and meet your financial goals. So hope you like this video. I'll cover a few more topics in detail in coming videos. Till then, Please subscribe to my channel if you have not done already. And if you find this helpful, please share it with your friends. If you like this, hit the like button, and I'll see you in the next video. Thank you.